Hello everybody, this is AK. I am back. So in last night's video I covered a few topics, and the first topic was how DBS profit for Q3 year on year went up 18%, and I said I was quite impressed. Right, so there was a comment from a reader which asked me something about price. Says, evaluating DBS, how much higher can its share price go this quarter and next quarter, especially with the recent unsettling global and economic issues? Well, I always say I don't have a working crystal ball. So my reply was, price is what we pay, value is what we get. So valuation has very little to do with price, specifically share price, and much depends on Mr. Market's mood. And I also said that this is why investing for income is comforting, because we are not at Mr. Market's mercy. Right? Because when we're investing for income, we are more focused on valuation, and we are more focused on the income that an investment is able to pay us. And we are not so concerned with market prices because we don't have to liquidate our investment in order to get paid. And so we are not at Mr. Market's mercy. We will get paid regularly as long as the business is able and willing to pay us, right? So of course, regular readers of my blog for a long time would know that I got into DBS. I became a shareholder back in 2016, right, paying $12 to $13 a share, and I still hold those shares today. And I don't see any reason why I should sell them because I'm being paid, and I'm being paid well, right, as an investor for income. And of course, there could come a time when I would sell. I would want to sell them, but I don't know when that might be now. So I'll cross the bridge when I come to it, right? And today I want to talk about DBS in greater detail. You see in the thumbnail, DBS and what Piyush Gupta said. It's a pun on the word what and what, right? So, but because really, if we are investing in DBS, we are really whatting, right? So what DBS CEO Piyush Gupta said was, we achieved record income in the third quarter as net interest margin continued to expand and growth in commercial book non-interest income was sustained. The successful integration of Citi Taiwan or Citibank's Taiwan consumer business has progressed our strategy of building meaningful scale in growth markets. As we enter the coming year, higher for longer interest rates will be a net benefit to earnings, while our solid balance sheets with ample liquidity, prudent general allowance reserves, and healthy capital ratios will provide us with strong buffers against macro uncertainties. We will also dedicate ourselves to executing the comprehensive set of measures we recently announced to address the series of digital disruptions for which we are truly sorry. We are committed to strengthening our technology resilience and ensuring customer service reliability. Of course, this last statement by Piyush Gupta regarding the digital disruptions, we already know what MAS did to them, and that's to bar them from venturing into new businesses and bar them from shutting down ATMs and branches until they are able to get their IT in shape, for lack of better word, to get things in shape, right? And hopefully there will be fewer disruptions in future. And I said in a recent video that I think they got off rather lightly this time. And hopefully they have learned their lesson, and or else the next time it happens, if it happens, they might not get off as lightly again, right? And if we look at the DBS number, right, it says that third quarter 2023 net profit rose 18% from a year ago to 2.63 billion Singapore dollars, right? And it says also the asset quality was healthy, and the What else? 9-month. Oh, this is something I want to point out. And there's a 9-month net profit increased 35% to a new high of $7.89 billion. Right. So you see the 9-month net profit increased 35% to a new high. But in the third quarter, the net profit increased 18%. So if we do a simple, number juggling, and we'll know that the largest gains are behind us. The largest gains are behind us, right? Even though DBS is still growing relatively strongly, growing its profits, right? But the largest gains are behind us. Like I say, funding costs have caught up, right? And also loan growth has slowed down. And they have a lot of liquidity, and they actually have excess liquidity, and it's harder for them to find productive use for that money, right? And I've said this in past videos. But another thing that we want to look at, which is good, is that the expenses, even though it grew 14%, cost to income ratio actually improved for 4 percentage points to 39%. Because DBS is a very digitalized bank, is able to reduce its cost of operations. But of course, now we know that if it continues to get disruptions to its online services, it could be costly. Right? It could get costly because we don't know what other punishment might be meted out to them, and also whether they'll lose, consumers will lose confidence in the bank, right? But its cost to income ratio has improved. And another thing I want to look at is the commercial book net fee income that rose 9% from previous year to 843 million Singapore dollars. And most of this comes from wealth management fees, which increased 22%, and also credit card fees, which grew 21%, right? Most of it is from these two areas, right? Everything in total, right? The net fee income rose only 2%. Only 2%, right? Because the investment banking fees fell 16%. So what this tells me is that DBS is attracting a lot of wealth, a lot of wealthy individuals and families to park money with them, and also to let them manage their wealth for them. And this is probably something to do with the spillover effect from the shutdown of Credit Suisse as well. That's just me speculating. And how Singapore is now is considered Asia's Switzerland. It's not Hong Kong, it's Singapore, right? And which is a good thing for Singapore, of course, Singapore's banks. And the credit card fees grew 21%. It's good and bad, right? It's good and bad. It also suggests that many poor people are spending money that they don't have, right? There's more being charged to the card, and there's more balances being rolled over. So, but it's all good news for DBS. All good news for DBS, right? Asset quality was healthy, but non-performing assets rose 6% from the previous quarter. So this is something I've been talking about as well, because businesses are feeling more stress, right, from the higher interest rates, and their corporate loan books are feeling the heat, right? Not corporate loan books, corporate balance sheets. Getting confused, right? Balance sheets are taking a hit from higher interest rates for companies which are leveraged, especially those which are highly leveraged. So DBS non-performing assets rose 6% quarter on quarter, and they have put aside allowances, right, to just in case this money cannot be recovered, right? And allowance coverage stood at 125% and at 216% after considering collateral. So it's pretty safe. Liquidity remained ample with liquidity coverage of 138%. Like I say, DBS has a lot of liquidity, and Piyush Gupta has already said before that they have like $3 billion in excess capital. Now let's look at the CET1 ratio, Common Equity Tier 1 ratio. It's at 14.1%, right? And I was expecting this to increase because they're more profitable than like OCBC or UOB, but 14.1% CET1 ratio was unchanged, and the reason is because even though there was some profit accretion, they had to offset the impact of Citibank Taiwan consumer business integration. Then that makes sense. So it's like how UOB, when they reported their latest results, they say that the integration costs, right, because they also bought Citibank's business in 4 Southeast Asian countries, the consumer business. So there's some cost of when it comes to integrating the businesses. So this makes sense. And the last thing I want to mention with regards to the numbers is DBS declared a quarterly dividend of 48 cents per share for the 3rd quarter, right? Yeah, what so that's DBS. Congratulations to all fellow DBS shareholders. Now, what about UOB and OCBC, right? So I've said I want to increase investment in DBS, but I also want to increase investment in UOB. And the reason is because UOB trades at a very undemanding valuation. It's at 1 times book, price to book, 6% dividend yield, right? Whereas DBS trades at 1.5 times price to book and slightly less than 6% dividend yield, right? They're both similar when it comes to dividend yield, but of course DBS pays quarterly and UOB only pays twice a year. The next dividend payout I think is in May, right? So OCBC trades at about 1.1 times price to book and also about 6% dividend yield. So they are all same but different in the sense that DBS trades at a 50% premium. It's a very rich premium to book value, but DBS has superior return on equity, ROE, like I said, right? So the ROE is like 18.6% and UOB is at 14.1%, OCBC at 14.3%, right? These are numbers I plucked from an analyst report. So this justifies its higher price, richer valuation, right? So that's all for this video. If AK can crunch numbers, so can you. Bye-bye.